Hey guys, this is Fred Passelli, CPA at Passelli Accounting Services located in South Florida, firm offering tax planning, tax preparation, bookkeeping services for small businesses and individuals. So today I just want to talk to you guys about some very basics about accounting. Basically the accounting 101, the foundation of accounting itself is debits and credits. So a lot of my content is normally around tax planning, tax preparation, tax strategy. But another thing that I offer is bookkeeping services. And one of the major things that makes up bookkeeping is financial statement accounts. And to increase or decrease those accounts, you have to make a debit or a credit to those accounts. Basically, a debit or a credit is going to be showing financial activity within those accounts. So I'm going to go over a little bit of what a debit and credit is, what some of the accounts have normal balances of. A normal balance is basically to increase that account. Do you debit it or do you credit it? So let's start off with the basics. What is debit? What is credit? So a debit, all that means in financial accounting terms is debit means left side. Credit means right side. So a lot of people confuse these with the banking terms, credit and debit, but for financial accounting terms, what I want you guys to focus on is debit specifically means left side of the account, credit means right side. So what that means now is debits and credits are what you're going to either do to increase the account or decrease the account. So there's 5 types of accounts I'm going to go over quickly today. There's assets, liabilities, equity, revenues, and expenses. So there's only a few accounts that are increased with debt, or types of accounts, better yet, that are increased with debits. Those types of accounts are going to be assets and expenses. The types of accounts that are increased with credits are going to be liabilities, owner's equities, and revenue/income accounts. So what this means is if you want to increase an asset account, meaning you purchased more assets, that's what that would mean, you would debit that specific account. So here's an example that you can use in your everyday business. If you are a store owner and you buy $500 of inventory for cash, you would want to increase the inventory account by 500. To be able to do that, you would debit, so your journal entry would be a debit on the left side of $500, and then you would credit cash, which is also an asset, for $500. So in this case, there's 2 assets that are currently being affected. Inventory is being debited, that's an asset, and cash is being credited, that's another asset. So assets, remember, increase with debits. So if they increase with debits, that means they have to decrease with credits. Liabilities increase with credits, that means they would have to decrease with debits. So basically, whatever's going to increase the specific account, the opposite is going to decrease it. So my original example, you're a business owner, you buy $500 worth of inventory for cash. There's 2 assets being affected in that transaction. The inventory account has to go up, so you would debit that for $500, and the cash account has to go down, so you would credit that by $500. The reason this is important to understand the difference between debits and credits and actually understand what's going on in your bookkeeping, whether that's QuickBooks, Xero, or a different financial software, is you're going to want to be able to actually understand the data that your financial accountant, your CPA, or even your bookkeeper is giving to you. So if you get a general ledger, which is basically a listing of transactions for specific accounts, you're going to want to understand what are the debits in here, what are the credits in here, what does that represent. If there's a net debit of inventory for $10,000 during a specific period, that means you probably bought more inventory than you sold for the period. If there's a net revenue for the revenue account or the sales account, that means you most likely sold more than basically returns that happened at your store or something similar. Revenue is one where it's always going to probably be a net revenue because the only time you're really recording things to that account is when you're making sales. But to get back to the key thing here is debits specifically mean left side. Accounts that are going to be increased with debits are assets and expenses. Some examples of those accounts, so like a specific example of assets are going to be cash inventory, equipment, land, accounts receivable, prepaid expenses, basically anything that your company or you as a person would own is going to be an asset. Another one is intangible assets, property, plant, equipment, that's normally grouped into one, notes receivable. So those are examples of assets. Examples of expenses could be pretty much anything your business is going to spend money on that is going to be used up in under a year or used up instantly. So let's call it office expense, supplies expense, rent expense, utilities expense, water expense, salaries and wages expense. That's normally a very big line item for account or for small businesses. So those are just some examples of expenses that would be increased with debits and decreased with credits. So then we'll quickly go into examples of liabilities. Remember, liabilities are increased with credits and decreased with debits. So examples of liabilities would be accounts like accounts payable, loan payable, notes payable, long-term debt. Basically anything having to do with money you owe or long-term debt that you have taken out. So think of liability as things you owe someone else, whether it's another company, individual, or banking institution. Then owner's equity or stockholders' equity, depending if you're working with small businesses or corporate accounts. Owner's equity or stockholders' equity is essentially the portion of the balance sheet, which we'll get into what that is in another video, that is actually owned outright. So remember, just to give some background, the balance sheet, that is assets equal liabilities plus stockholders' equity. So all your assets on the balance sheet are either going to be funded by actual equity, which is ownership in the company, or by liabilities. So in this case, owner's equity is going to be original owner's contribution. It's going to be retained earnings. Retained earnings, just to go into that a little bit, is going to be the accumulation of net income at a company. So retained earnings is over all the years, your net income is going to accumulate there that you retain and then you continue to add cash into your business or buy assets with. That's where that's going to be there. So it is possible also retained earnings could be negative if you're at a loss every year. So basically the main thing is common stock would be the initial purchase or contribution to your business or paid in capital, sometimes it's called, and then retained earnings. Once you go into retained earnings, you have some of the other accounts that are increased with credits, which the main one we're going to talk about now is revenue. So revenue is going to be increased with credits. Revenue could be all types of different things. It could be sales, it could be service revenue, it could be dividend income, rent revenue, miscellaneous revenue, commissions, fees, anything that you're going to earn as a business owner or as an individual is going to be something that is revenue. So basically, when you're earning revenue, you're making money for your business and you are recording that with a credit. If you want to decrease that account, it would be by a debit. So just to take a step back, reiterate what we went over. 5 main accounts that we talked about, or types of accounts: assets, liabilities, and owner's equity. Those accounts are all balance sheet accounts. Something we'll go over in a later video. But the balance sheet accounts, assets, liabilities, and owner's equity. So assets are increased with debits. They are decreased with credits. Liabilities are increased with credits. They are decreased with debits. Owner's equity is increased with credits and it is decreased with debits. Now, revenue and expenses, those are different types of accounts. Those are actually going to be called what we call income statement accounts. So income statements are essentially your profit and loss. So it's revenue minus expenses equals your net income or your profit and loss. So revenue, like we talked about earlier, that is going to be increased with a credit and decreased with a debit. Expenses, all expense accounts, are going to be increased with a debit and decreased with a credit. Now, there is one other types of accounts that I will just mention right now, and that is dividends. That's normally on the statement of retained earnings. The statement of retained earnings is one of four main financial statement accounts that we'll go into on a later chapter, or really just later lecture / video that we're going to have. And basically, dividends acts similar to expenses. It's going to be increased with debits and decreased with credits. So the main thing that anyone watching this video today that I want you to take away from is the three balance sheet types of accounts. Assets equal liabilities plus stockholders' equity. That's the balance sheet, and those are the three types of accounts. Assets are increased with debits, decreased with credits. Liabilities are increased with credits, decreased with debits. Equity is increased with credits, decreased with debits. Income statement, the second financial statement, basically has revenues and expenses. Revenues are going to be increased with credits and decreased with debits. And then expenses are going to be increased with debits and decreased with expenses. In later videos, we're going to go over the four major financial statements and other types of accounts. And we're also going to throw in a lot of different tax strategy and planning videos in the future as well. I want to thank you guys for tuning in today, coming to my video, learning a little bit about accounting. I'm hoping to make more of these where I can basically dive into all types of financial accounting, tax accounting, and other types of interesting accounting videos that people want to hear and learn about. Thank you.